I want to go over the underlying concept here of accounting profits versus economic profits. I consider this to be probably one of the key underlying concepts in the study of not only microeconomics but also of macroeconomics. And in dealing with accounting profits, I think accounting profits is a relatively easy concept to understand. Accounting profits is nothing more than taking your revenue or your sales and subtracting off all your costs, total costs. Specifically, it would be your direct costs. So sales revenues minus costs or direct costs, and hopefully we would end up with profits. So in business, and of course in accounting, if our revenues exceed our costs, direct costs, we would end up with what we refer to as accounting profits. Vice versa, if our revenues or sales less than our costs, direct costs, we would end up with a loss, what we refer to as an accounting loss. When we come to economic profits, and that's really what I want to go through in this short video presentation, is a little bit more complicated. And there's a reason why economic profits are very, very important in a market economy. And hopefully I'll explain that at the end of this video presentation. So really what we have here, what I have in front of you, and I'll put this up. Of course, the video is going to be uploaded to the course, but I will also have the document here where you can kind of go back and follow along. So, in this particular example, what I'm proposing, what I'm giving you is that, hey, you just graduated from college in a degree, in a good field, of course. I would consider that to be some aspect of business, and you find a job paying $90,000 your first year, which of course would be a very good job. But instead, you have the entrepreneurial spirit, you want to go forth, and you just say, you know what, I'd rather focus in on being an entrepreneur, I'd rather do something on my own, and you decide, okay, I'm going to go ahead and I'm going to be a true entrepreneur and I'm going to do what I've always wanted to do. So at the end of the first year running your business, as indicated here, you add up all your revenues and subtract off all your expenses, direct expenses, right? Direct expenses. And what I'm referring to here about a direct expense would be those expenditures where you write that check, you have the so-called cash outflow. And the difference, as I pointed out earlier, is called a profit. And in this particular case, you do have a profit here. And I'm saying your first year revenue is $180,000, and all these expenditures, the cash outflow that you wrote these checks for, is $130,000. So on the surface, from the standpoint of a profit, from the standpoint of an accounting profit, you made $50,000, which is, of course, is very, very, very good. So now let's kind of focus in on an economic profit. As I just pointed out, when we look at a profit from the accounting standpoint or from a business standpoint, right, it's revenues minus costs, direct costs. We wrote all those checks. When we come to an economic profit, it's a little different. As I said, it's not quite as straightforward, but it has major significance when we come to looking at the economy, when we kind of look at what is going on what is going to be produced, what's going to be manufactured as such. So when we look at it from this standpoint, and we're going to go back, and what we're saying, as I pointed out here, consider the foregoing income of not taking a great job, right? At $90,000. Your total cost would be $220,000. And you might say, well, where did I get that $220,000? Well, again, when we look at the economic profit as such, we have to take into account economic costs. And you're saying, well, what's economic costs? Well, economic costs takes into account direct expenditures, the direct costs, like we had that $130,000, all those checks you wrote, plus an indirect cost, or from the standpoint of the income that you foregone by going into business for yourself. You could have had a $90,000 a year job, but you said, no, I'm going to go into business for myself. That is what we refer to as an opportunity cost. What are you giving up? What are you giving up? In this case, what are you giving up to go into business for yourself? Well, you're giving up that $90,000 a year job. So from an economic standpoint, that is what we refer to as an opportunity cost. And when we look at it from the standpoint of an economic cost, we have to include the opportunity costs along with these direct expenditures. So that's how we came up here, over here with this $220,000. So from this standpoint, when we look at it from an economic standpoint, your economic profit, would not be a profit, right? Because your revenue is $180,000, and we're going to subtract off economic costs, which are these direct costs of $130 plus the opportunity costs, $90,000 that you gave up. You could have had a $90,000 a year job. So when we look at it from the standpoint of an economic cost, that's where we get the $220. So our revenues, yes, is $180, but from an economic situation or an economic cost is $220,000. So therefore, you would have what we refer to as an economic loss of $40,000, or an economic loss for the first year. Now, kind of once again, let's look at that opportunity cost, right? It is a cost to you might say, of reading this document. It is just not the cost of this economic course. So what is the cost of taking this course? Well, it would be your out-of-pocket cost, right? Of taking 3 credit hours here at Drury, to take the Econ 211, plus whatever you have foregone. Could be income, maybe your job, maybe a part-time job, or whatever it may be. So when we look at it from an opportunity standpoint, or opportunity cost, remember it's direct costs, the cost of your tuition, the cost of books, plus indirect costs, which we would consider to be what you have foregone. First of all, by taking the course, listening to me right now. So we have to take that into account. And so when we sum, right, direct and opportunity costs together, we get economic costs. So when we look at economic profits, it will be the revenues, sales, minus this underlying concept of economic costs. So from a business standpoint, we would like to have economic profits. Economic profits. The way I usually go through this and discuss this with my students, I say, let's look at certain things. Let's look at, say, electronics. I use the example of calculators. Now, this is going to date me. Way back in the 70s, late 70s, I was doing an MBA in New York City, and I was working for a bank down in the financial district, and I got a hold of a handheld calculator. And bear with me as I tell this story. A handheld calculator that had 4 functions: add, subtract, multiply, and divide. It was a Sharp. At that particular point in time, believe it or not, you could not get an American-made calculator. Sharp, Japan. And the reason why I had availability of this Sharp is due to the fact that at that particular point in time, my wife worked for Bulova Watch. And Bulova Watch had a manufacturing facility in Japan. So I was able, through her, through the company, to acquire a 4-function calculator for $396. If you bring that in today's terms, that'd be like $1,300. Now, what's my point in all of this? What's my point in all of this? My point is simply this, is that that particular calculator, Sharp, that produced it, Sharp was definitely making economic profits. That is, in other words, if you look at it from the standpoint of direct costs of producing a calculator, plus their indirect costs, and that would be something to the fact of, oh, I consider it to be like a rate of return, a built-in profit. They had economic profits. And that is nothing more than, in other words, they didn't need, right, those economic profits. They didn't need those economic profits as such. So what transpired in the United States way, way back then, the first company that made handheld calculators was a company by the name of Bomar. You cannot find Bomar around today because they did not survive. Bomar was the first one, American company, that produced calculators, what we consider handheld calculators. And why did they do that? Because of economic profits. They said, if a company like Sharp can do it, we can do it. And lo and behold, what transpired? You had Texas Instruments get into calculators, Hewlett-Packard, and sooner or later, what were they after? They were after economic profits. You see, and that's why I place such emphasis on economic profits, because economic profits is telling companies that the consumer really wants the product. So therefore, companies will come in to fill the void. And what are they after? In other words, they're after those economic profits over and above that which is necessary to stay in business. And so I say, what do you buy a 4-function calculator today? Well, you can't find them, right? Simply due to the fact they don't make them. They're high tech. I use a TI Business Analyst 2. It's amazing what that thing does. And when you get into finance, I mean, that's the calculator. I teach finance, and that's the calculator that I highly recommend. My point is that $396 for a 4-function calculator. I mean, you buy a calculator today, the TI Business Analyst 2 Professional, for approximately $60 to $70. That'll do everything. Capital budgeting, future value, you name it, it will do it. Hey, look at computers. Look at computers, the cost of computers 10 years ago versus what they cost today. What about TVs, right? 4K. What they were 10 years ago. I mean, you can go out and you can buy a 55-inch, 65-inch for what? $600 today? Compared to what? $2,500, $3,000 10 years ago. So again, the bottom line is what I'm trying to bring forth is that in economics, to have a good understanding of what we mean by economic profits and the reason and the significance of economic profits to consumers. Because the consumer is screaming, I want more of this product. So companies will come in to meet that demand. And as we will find out when we talk about demand and supply, right? What will happen is that the supply will increase in relation to demand, and if supply increase is greater than demand, price will come down. And in every instance that I mentioned, calculators, computers, TVs, any type of electronic product, the price over the past 10, 15 years has decreased. Why? Because of economic profits. That is a signal to the marketplace that consumers want more, and companies will come in to produce more is because they're after economic profits. And those are the profits that are over and above that which is necessary to stay in business. See, all what a corporation needs is what we refer to as normal profits. And that would be where revenues equals economic costs. Right? Direct and indirect. Normal profits. Hopefully this solidifies going back to really what we mean by accounting profits and economic profits and the significance of economic profits.